the founder will always be the number one thing. I want to see what they have been able to achieve without capital.
Welcome back to Venture Muse Club podcast, and in today's episode we'll be diving into the investor's mindset. Our today's guest brings a very rare mix of experience from being on both sides of the table as the investor and the founder of multiple consumer brands. Along the way, he's raised capital, navigated challenges of rapid growth, and now he's applying everything he's learned as an angel investor and a founder. So if you are a founder or an investor who is wondering how to make their consumer brands grow, this is the episode you don't want to miss. So without further ado, let's welcome our guest. Welcome, Bjorn. Thank you for being here. Great to have you.
Thank you so much.
So let's kick off today's discussion with the first question. So you obviously have evaluated brands as an investor in the context of being in the venture capital fund, and as an angel investor, you have built brands as a part of the founding team, and now you are scaling multiple brands at once in the context of Wild Ventures, the house of brands that you're building. From everything that you've seen and experienced, what would be like one hard truth that you feel like consumer brand founders or investors sometimes get wrong?
I think a big thing is always coming down to distribution. So I think especially with first-time founders, they tend to underestimate that you really have to nail distribution. And with distribution, I simply mean getting your product in front of an audience. So a lot of first-time founders will pour their time and energy into perfecting a lot of small things that ultimately won't matter if you can't get your product into the hands of an audience.
And by distribution, do you mean purely getting like retail partnerships, wholesale partnerships, things like that, or in combination of marketing?
It really depends on the business model. So typically, I think like 10 years ago, it was a super strong movement of D2C. Everyone wanted to only sell directly to the consumer through their own channels. But nowadays, I feel like more and more people are waking up and realizing that if you have a brand, you typically simply want to be able to reach them in whatever channel your customer feels the most comfortable with. So that might mean that you start D2C, but then along the way, you will have to add some retail partnerships, for example. So with distribution, I mean more just being able to find the channels, the avenues of growth to reach your target audience. And that will be different for every brand. But the main thing is that you have to find them. Typically, like the most successful brands, they often find one channel, be it a marketing channel, for example, could be Instagram, TikTok, whatever, but they find one channel that works really well for them, and then they can scale. And at the same time that they scale, then they can work on the other channels and work on partnerships, work on wholesale contracts, etc. But the key thing is that you have to just get your product out there. You have to find your audience.
And I'm guessing hand in hand in that with that goes having really strong unit economics for a brand, because if you are going to get into the retail partnerships and the retail model, like I know, for example, with beauty brands, like if you get into a Mecca or a Sephora, that a big chunk of your gross margin is going to go to Sephora or to Mecca. So from my experience, I feel like a lot of brands sometimes underestimate how much margin they need to make in order then to afford retail partnerships down the line.
Yeah, no, for sure. That's so true, because I think that's the whole point, that if you're an Amazon or Sephora or whatever marketplace it may be, they know the importance of distribution. Like they know the value that they bring, which is millions of customers. And unfortunately, they will put a very high price on essentially giving you that distribution. So that's why if you don't have the margin to start with, and when I talk about unit economics, I typically look at two things. One is the sheer percent. Of course, you have to have a strong starting gross margin in percent, but you also have to have like a high enough unit price or average order value that it makes sense, because a lot of these marketplaces, for example, they will have not just like a percentage, but they will also have some fixed fees. So if you don't have strong enough unit economics to begin with, it's going to be super tough to cover all that.
Right. So does that then translate into the fact that if you are a brand that wants to target more of a mass audience or be like mass product, then you are starting off on a back foot from to begin with, because then your margins are a bit lower?
Typically, yes. I mean, then you will need volume, right? That's the main issue. If you are like, typically that's why if you start a new brand, you have to bring something unique to the market, right? And if you are just playing like a price game, if your real value is that you're cheaper, it's going to be super tough because there are so many big players out there that have the economies of scale. They control the supply chain. They have already perfected the product to be able to sell it cheaply. So typically that will require you to either have some technical innovation. That means you can, for some reason, supply at a much lower cost than the competitors, or you have to have a lot of investment, because if you don't have the volume, it's going to be really hard to compete on price.
Yeah, pricing is not a competitive advantage. Like, it's just one of the features of your product, of your brand, but you can't compete on price because there's always going to be a bigger brand out there with like much larger economies of scale who will always be able to outperform you on price.
Yeah, exactly. And typically, in my view, like, you're not really a brand if the only thing you compete on is price. Then you are, you're a retailer or you're a platform, but you might not be a brand per se.
So switching up the gears a little bit. So many investors, particularly venture capital funds, even some angel investors, they really tend to favor tech and software brands over consumer brands. And you have experience and background in both.
I would say that for many funds, they are correct. So like many investors shouldn't necessarily dabble in consumer goods or consumer brands if that's not what they're used to, and if that's not how their fund is structured, and if that's not the experience of the team that they have. Because after all, like, it is very different trying to invest in a consumer brand versus a B2B SaaS product. And the other thing is, typically, if you look at the data, you can see that the craziest outcomes, like the really, really high valued companies, tend to be consumer companies, but also it's a much higher rate of failure along the way. So it's typically harder to nail. Whereas in, for example, B2B SaaS, it might be easier to get to like a decent outcome, but harder to get that kind of crazy consumer outcome. So it's all about risk appetite at the same time. But at the end of the day, it's like, it depends on what you're comfortable with. And not all funds should do consumer, for sure not.
It's interesting that you mentioned that consumer brands have a higher rate of failure compared to tech brands.
I think the main thing is that right now, like when you look now, the barriers of entry within consumer has gone down drastically. It's very hard. It's very easy now to launch like a Shopify brand. Like anyone can put up a Shopify website, go on, Alibaba and buy in bulk and then start selling. Like, to do just like a drop shipping operation, it's not very hard. But at the same time, of course, now I think with AI, it's almost getting as easy to set up a B2B SaaS company too. So let's see if that's still going to be true in a couple of years from now. But in my experience, it's like right now it's very hard to break out as a consumer brand because it's just so much noise. There are so many consumer brands that you really have to have something unique and really have that hunger that can actually make you a breakout brand.
So digging into that a little bit further, when you were investing in consumer brands, either in the context of a venture capital fund or now as an angel investor, what are some of the top 3 to 5 factors that are a real green flag for you when you are looking for a brand?
I think when it's very early stage, which is typically what I look at, the founder will almost always be the number one thing. Like the founder or founders, they need to have that hunger, they need to have that grit, and they need to bring something unique. I really want to see a unique insight and a key unfair advantage that they can bring to the table. Either something in their background or just some insight that they bring to the table that most other people simply don't have. And then to me, it's like all about the unit economics and the opportunity out there. Like, can they explain what is going to make this brand successful compared to the 99 brands that might look like do something similar? Then maybe I will take a look. But yeah, like right now it's very, very crowded. So you do have to have some very unique insights or a very like key. It can be like something around supply chain. It can be something around distribution. That's why right now there are many like celebrity brands or influencer-led brands because they have that distribution to start with. And of course, that is a key advantage that most other founders simply don't have.
And on the flip side, what are some of the most common mistakes do you see founders make that would kill their chances of ever getting funding?
I think a main mistake is to simply underestimate all these things. So a lot of like, of course, if you come and your unit economics are kind of broken from the start, it's going to be super tough. Like if you are a consumer brand starting with less than, like 50% gross margin, yeah, it's going to be incredibly tough unless you are in like a specific industry where that might make sense or a marketplace. But typically, otherwise, what I see founders have a hard time really nailing is, and what investors tend to look for, is resourcefulness. So a lot of founders, they simply can't, like they think that they need to raise investment even to just get started. And in my view, I'm always like, okay, but if you have to do that, why would I think that you will be able to manage that capital well?
Yeah,
you have
it's
to
like what's going to happen later.
Yeah,
then,
exactly. Like I don't want to give you money just to set up a website. Like you should have been able to do that yourself. So I want to see what they have been able to achieve without capital, because that will be a somewhat okay indication of how much can you then go when you have capital.
Yeah, I agree. And I also feel like similarly to that, one of the mistakes that founders make is thinking that they need to raise capital much earlier than they actually do. And they almost see it as a sign of success, or like, oh, I've made it, I've raised capital,
Yeah,
like it makes me legit. But it's you're diluting yourself so much earlier, you don't actually have so much to show. And I feel like it also digs into your commercial discipline. Because like when all of a sudden you don't have to like survive for every dollar that you spend, and you actually like you raised some money either from angels or friends and family or whatever it might be, then your commercial discipline is a bit more relaxed, and then it actually ends up backfiring.
No, it's a very big problem, a big issue. And I think what many people underestimate is that if you're building a consumer brand compared to, for example, like hardcore deep tech company, you don't need all that much capital, one. And two, you have to understand that the brand is the value. And brand building takes a long time. Not just, there are some things that just take time by nature, like, for example, SEO. Like SEO takes a long time. You can hack it in many ways, but you will never be able to go from 0 to 100 in a month. It's just not how SEO works. But another thing is also that in the minds of consumers, brand building takes a very long time. And you have to accept that. Like if you look at all the top brands today, they have been around for a long time. They have been essentially cultivating that brand experience year after year, campaign after campaign. And you have to let that take a little bit of time. And that if you burn all the money in day one, well, you're not going to be able to get there.
And then do you feel like then this makes consumer brands more a better fit to raise money from family offices or angel investors as opposed to VCs, because then family offices typically have a bit more patience with their capital and they can are a bit more flexibility in terms of when they need to have an exit?
It depends on the stage and the type of fund, in my experience, because some funds are experts and like very niche and looking only at consumer, and then they understand the cycles, and then it's fine. But typically, like if you too early go to a generalist VC that might have mainly like B2B investments, they will probably become a bit impatient and try to push you to do things that might not be in your best interest too soon. Because at the end of the day, like if you look now at the 50 biggest companies in the world by market cap, more than 15 of them are consumer brands or typically house of brands, so that they have several brands under the same portfolio or under the same umbrella. And they have been around for ages. So like that's the thing. It typically takes a bit longer to get started. So you have to have a bit more patient capital to start with. But that doesn't mean that you can't raise VC money down the road. It just might be that you don't want to start off with VC money, but maybe, when you're 3-4 years in, that might be the perfect time, because then you might have figured out exactly how to scale quickly. You might have network effects. You might essentially be able to just like pour fuel on the fire and make it spread quicker. But if you haven't figured that out, then VC might not be the best route.
And do you feel like once the brand raises money from an investor like a venture capital fund, then they have to keep raising, or can it be sort of like a once or twice done exercise?
It all depends on the VC fund typically. Some, like as I said, there are many consumer funds that really understand consumer. That it can be like the likes of Forerunner Ventures in the US, Felix Capital in Europe, etc., that deeply understand how consumer works. And a lot of them, they will invest once in maybe an already profitable consumer brand or a consumer brand that is near break even. And then they will work with the founders to simply become more profitable but be able to keep scaling and stay there until exit. So it really depends. Like some will want to have more of the traditional VC style, like Series A, Series B, Series C. But at times, like if you find the right VC, they will be totally okay to do a one and done kind of round.
So for example, if we have a founder who has got their, unit economics figured out, they've got the foundation straight, the brand has been around for like 3 to 4 years, so they would be in a good place to start looking at capital, and it would be like a healthy time for them. What would you say a founder should do to make the brand more investable, or like make a founder more, like give them higher chances at actually raising money?
The one thing, so typically the number one thing is you want to always create competition and scarcity, even if you have to do it like artificially. So for example, the way to raise funding is just like with dating. Like you want to make sure that people feel like you're in demand.
Yeah.
And the way to do that, like typically the investor community is very tight knit. They all talk to each other. So you have to make sure that everyone knows that you are the hot brand in town and that you are going to be racing. But the big mistake I see a lot of founders do is that they're always kind of racing. And the big issue there is if you've been kind of racing for 8 months, that means every single investor knows that you've tried and failed.
Yeah.
Because either you're, in my view, like either you're racing or you're not racing. But this like, I'm kind of like, let's see
we're
if something...
thinking about it, like we're exploring
and then
the
it's
route.
like, the big issue is that no VC is going to drop a term sheet in your lap just because you're like saying that maybe we can look at investment. Like that's not how it works.
Yeah.
Like the hottest company around and you know that you will be able to raise in 2 weeks, like maybe some VCs will preemptively approach you. But most of the time, you have to drum up that interest, which means that you have to prep everyone that we will be racing, and you have to make sure that word gets out and that people are like anticipating that race. But once you do start, you have to make sure that you try to talk to as many investors as possible in as short time as possible, because you want to be able to show that like, okay, now we have this term sheet coming in, and you want like investors to really hear about you from so many different sources that they get all like, oh my God, if we don't act quickly
FOMO.
now, we're gonna miss out.
Yeah.
So that's the number one thing. And the other thing is also that I see a lot of founders don't understand that you have to have momentum. So you have to, whether it's artificial or not, like you have to raise money when you are in a really good position. The last thing you want to do is to raise money when you really need the money, because investors, they know that. Like the problem is investors, they typically have all the time in the world. So if you are just waiting until the last minute and you don't really have any news, you feel like you're struggling, the investors will feel that too. And why would they then want to give you great terms? They won't. So you have to really, really have good momentum. Like that's the best thing. So if you're in a seasonal business, you want to make sure you time that race, because it could be that it's a super seasonal business, but the investors might not be as knowledgeable about it. Or you feel like, okay, we just hit this major milestone, and then you want the whole world to know about it.
Wow, it's very interesting. Yeah, definitely. I think I love your analogy with raising. It's like dating. Just make sure that you're in
it's
demand.
It's a mind game.
Yeah,
like
it's
really psychological. You have to be really good at storytelling, and you have to really understand how to create FOMO.
And it feels almost counterintuitive to raise at a high, right? Like when your brand is doing so well, like, oh, I'm doing amazing, I just hit this major milestone, now is the time to raise. And yeah, I feel like there's a lot of founders raise out of need.
Yeah.
And then that shifts the power balance when you are trying to negotiate better terms for your investment.
Yeah. And one more thing that I see a lot of founders consecutively get wrong, especially first-time founders who raise their first round, is that they underestimate how many they have to talk to.
Right.
They think that if I talk to 10, 20 investors, wow, I've talked to so many. But most of the time, if you don't already have a big network of investors, you should target talking to 100 or more. Like that's what it takes. And you have to be fine with that, which means you will be rejected by a lot of people. Like it's going to be a struggle. You're going to hear so many no's. You're going to be ghosted so many times, and you just have to be resilient. And it's just what it takes. It does not mean that there's something wrong with you or the company. I mean, it might, but you shouldn't take it as that. Like you have to just keep going. If you talk to enough people, you will find someone who believes in you. That's the number one thing. And also just like keep asking people for intros, because you never know who happens to have an uncle who is a like serial angel investor, or whose school teacher hit the jackpot. Like you never know. Just ask everyone for intros.
And I feel like that's especially true in Singapore, because you never, like, it's like somebody always knows somebody. Like even if you first have a conversation with someone and they feel like, oh, it's like this maybe not the most useful conversation. Next thing you know, they're married to someone, their brother-in-law is someone else, and it might come out to be the most useful conversation ever.
Oh yeah. I'm doing that right now, but not with investors. But I'm doing it because we are just about to launch a home decor brand. So I'm looking to talk to interior designers. And oh my God, everyone knows an interior designer. It's great. So like I've just started asking everyone I meet, hey, do you know any interior designers? And people do. So it's just like always have that mindset of every conversation being able to lead to something else.
Yeah, and I actually made a LinkedIn post recently about like the importance of kindness and the importance of not being, I don't know, can I say it? Like not being a dick to people.
Yeah.
But, just because you never know like what might come out of something. Be a good person. And then people usually tend to return favors if you give them the time of your day.
Yeah, for sure. Like some of our investors now, it's people that like I randomly helped with something 10 years ago, and we've just stayed in touch. And then now I was like, oh, hey, like, this is a good guy. Why don't I hit that person up and ask if they want to invest? And then, like chances are they'll say yes.
Chances are something like will come through. Yeah, something like random relationship from years ago. So as an angel investor, like you have backed a few different companies. What is your approach to finding and evaluating consumer brands? Like, is it something you just stumble upon, or do you actively go out and look for deals? Kind of how does that process typically work for you?
So nowadays, like I'm pretty busy with my new company, so I don't actively look for angel investment opportunities, but I'm part of a couple of networks, like angel networks, syndicates, and I also get pinged because of like previous investments. So it's mainly like I don't really have time to go out and proactively chase deals. It's mainly referrals by now. And again, it's like, to me, it's the most important thing is the founder, most likely, because most of the time these are going to be very, very early stage deals. So it's like, who is the founder? What have they been able to prove so far with limited resources? And what kind of unique insight or unique advantage do they have that I believe in?
Yeah, like what sort of edge do they bring to the table that makes you believe that, this founder actually has it?
Exactly. So it's like either it can be something very concrete. It could be like, okay, I exited a couple of companies before and I kind of found a playbook and I found a new, hole in the market. Or it could be I have a, massive following of B2B SaaS company CEOs and we're selling this specific product to them and I can reach them straight away. Or it can just be like a super unique insight that no one else has really thought about. And if I can validate that, then it might be worth betting on if I think that it's a good founder fit as well.
So if a consumer brand founder wants to attract an investor like you, like what's the best way to like stand out and approach an angel investor?
I mean, relationship
it's a big
building.
sigh.
Yeah. No, I mean, first of all, like I don't invest in brands typically. Like I invest a lot in consumer, but not necessarily brands, to be honest. Because a lot of times I feel like many brands should be able to launch without much investment. So if they have to chase, then that always gets me a little bit worried, actually. But otherwise, yeah, I think it's more about finding, like one, being able to really show that you've been able to accomplish things in a short amount of time without resources and actually being able to like secure key partnerships or whatever it may be. But the other thing, what I really look for in a brand is customer obsession as well. That you have either like crazy high retention or you're becoming part of a cultural movement. But that can also, like, that is also something I'm a bit careful about because that can also easily change. So especially like if you're in a category like fashion, for example, it's going to be very, very trend driven. And then you have to prove to me, how are you going to not become a fad? Like, how do I know that you will be able to become like a timeless classic rather than, oh yeah, they were cool, 5 years ago. And then what happened to them? They just died. Like they couldn't understand how to jump on the next trend. So that's something that I like. You want to have both. You want that customer obsession, but you also want to make sure it's not just a fad.
Yeah, and that the brand and the founder has ability to stay like adaptable to whatever different trends or whatever's going on, and then like listen to their customers and then take on feedback and then iterate and adjust.
Always stay relevant, like relevant and timeless. So like you have to acknowledge the trends, like because you can't just be like, oh, we're totally staying outside or above trends. But if you do jump on the trends too much, you're going to be competing with Shein. And that's not a great space.
And it's not where you want to be, yeah. So earlier in your career, you went from analyzing brands and investing in brands onto the other side of the table and being on a founding team of one of the biggest, and then you went on to building a direct-to-consumer brand. So what was the biggest sort of realization or reality check that you realized when you sort of went from one side of the table to the other?
I think one thing, I think anyone starting out either in like, I don't know, consulting or banking or investments and then going into an operator role will always have the same kind of wake-up call that, oh my God, the slides that looked so pretty, it's a lot more messy on the actual inside. It's just like, especially if you're scaling fast, right? So like we grew from 0 to 200 mil in 5 years, which meant that every quarter, it was essentially a totally different company. So like when you're growing that fast, so many things are happening so quickly that you might be able to make look nice on a board deck, but on the inside, things are just breaking all the time and you constantly have to invent the wheel again and put out fires. So I think that's the number one thing. And the number one thing where I really, like what really impresses me about the best founders is how they can constantly make sure that they fix the most urgent things that are breaking and like put out the most urgent fires at the same time as they have like one foot in the future, so that they can really juggle like both going for the big vision, but also fixing, whoever random person quit that morning or whatever, like the platform went down because of some DDoS attack. Like it can be anything. You never know. Like every day you wake up and you don't know that something is going to go wrong today, but you don't know what. So like despite all of that, you always have to still be able to keep like thinking about the future and how can we tangibly get there by doing something concrete today while everything else is on fire.
It actually sounds like being not just a founder, but being on a founding team. It's such a mental health exercise too. You really need to be able to manage your stress, anxiety, stay cool under pressure, keep the long-term vision.
If you also have a team underneath you, it means you also have to be like a teacher
people
at the same time,
too,
and like sometimes a parent. Like you have to manage their mental health as well. So yeah, it's you have to be able to juggle a lot of things at once.
A lot of different things. So in that role, what do you feel like were some of the most effective strategies that you implemented that helped scale Naked so fast?
I mean, it all comes down to the team, to be very honest. But then, of course, we were very helped by being like bang on in terms of market timing. So we were one of the first companies that really made like influencer marketing and social media a machine. So at any given point, we were working with thousands of influencers, and we essentially turned that into a factory. Like we were able to use data to really analyze what was working and not, and scale it. I think most other companies at that point, they were mainly working with influencer marketing, mainly worked with maybe 5-6 different influencers.
Yeah.
Felt like, oh no, it was super expensive and we didn't get any sales, and then they stopped. Whereas we saw it more like a venture capital thing. So we knew that, okay, most are not going to work, but if we work with enough of them, some are going to work and it's going to work so well. So then it's worth working with like 10 that don't scale. So I think that was like a unique insight and like one channel that we could really scale, while then making sure that when we had done that, we could then focus on the fundamentals for all the other channels as well. So that after a while, we were not like dependent on any single one channel, but we had already reached enough scale that we were able to like actually invest in those other channels. Whereas if you can't find your secret sauce from day one, it's very hard to try to become competitive in like 10 different channels at once. The other thing which we were pretty good at doing, which the marketing team really excelled at, is to essentially become best friends with the platforms. So like with Facebook, with Google, etc., to make sure that you become the test pilot for everything. If you become like the coolest brand around, and you will all like Snapchat, YouTube, like they will always have new features that they're looking for pilots. If you can become that kind of go-to brand, that they know that, okay, this brand, they have big enough scale and they're always saying yes. Like they're always willing to try, whether it's, you know, Instagram shop or live or whatever it may be, then you can also get a massive advantage by getting access to tools that your competitors don't.
Wow, that's a very interesting one, to try and become buddies with the platforms on the back end. Yeah. I know that like Meta, for example, now like they're doing all the calls with creators and then trying to explain to them how the back end of everything works. And yeah, like you hear a lot like success stories. People learn how the new sort of algorithm changes are going to come up and what you actually need to do. And looking back, is there anything that you would have done differently?
So many things, for sure.
It's like a whole podcast episode just on that.
I mean, I think if I look at what I've been doing is to constantly move towards stronger unit economics,
right,
and maybe less competitive markets in one way. So for example, so like within fashion, which is where I kind of started out, it's pretty tough when it comes to unit economics, depending on what kind of brand you have. And then especially if you sell online, you typically have a lot of returns. So that's typically like a killer as well. So what I did then after that was eyewear, which has like crazy high margins and very low returns. But you still have inventory, which kind of sits and weighs down your balance sheet. And then now, like I'm in a whole different industry altogether where it's like extremely high margins, no returns at all, and no inventory. So I think that's like the main learning from start, that I want to be in a place where I can have a super strong both balance sheet and unit economics to begin with, because that just gives you so much more flexibility to try new things. So I mean, that's why we burned a lot of venture capital to get to that scale. But I think if you have strong unit economics to begin with, you don't necessarily need to raise all that money.
So instead of launching one brand, now you're launching like a whole portfolio of different brands. Sort of what was the thinking behind that model?
So, I mean, first of all, it's still very early days, so let's see if it actually is a stronger model. I mean, we hope so, and on paper it looks like it, but let's see. But I think what we realized was that we have, like in the founding team, we really have all the skill sets needed to launch world-class brands from scratch. And then we've also been able to secure unique advantages from the get-go. So that can be like super strong partnerships in supply chain or manufacturing or distribution, something which we know that most other competitors can't. And that's why we feel like, okay, that makes it very viable, that we can scale it faster and with better unit economics. And the other thing as well is when you have a house of brands, you can get synergies between the brands. So we do both B2B and B2C brands, where the B2B brands can essentially become a supplier to the B2C brands. And I think that's like the main thing we've been looking at is, for example, LVMH. They have incredible synergies within the group, but most people don't know how big LVMH is as a group. It's so many companies and it's like within marketing, distribution, supply chain, and so many different brands
manufacturing,
that reinforce
everything. Yeah,
and most people think like you can only see the top of the iceberg, but the real value sits underneath the surface. And that's the kind of model we want to replicate, where we have very strong synergies within the group.
How do you identify what's missing in the market and what sort of brand do you want to launch next?
So one thing we focus on a lot is that we want to find kind of big traditional verticals where there's not a clear winner in terms of brand, or maybe there are like big brands, but they're kind of stale. They're not very innovative. They don't have a lot of customer love, like low NPS. And instead, like if you want to go after like a Nike or Coca-Cola or Apple, you have to invest so much in brand because, oh my God, these are strong brands. And I mean, I have invested in a competitor to Apple called Nothing.
Yeah.
And I mean, they're doing tremendously well, but they have raised a ton of capital. Most brands can't raise that much money from the get-go. So most brands probably shouldn't try to go after those like absolute winning brands. So for us, it's more about identifying big but stale verticals where we can really come in with a fresh brand and a fresh approach and make sure that customers just love us. Because it might be that we are more community driven, we are more sustainable, and we're just more creative in general. Whereas these established brands, they oftentimes look the same as they did 30, 40 years ago.
And it's funny you mentioned Nike because I feel like one of the poster child examples is Gymshark and how he went out after Nike, Adidas, all the big brands. And now Gymshark is one of the case studies that gets brought up so often in the world of building new brands.
I agree, but I think the good thing, like he went after a very specific vertical, a very specific niche to begin with.
Yeah.
Because Nike never said that like, oh, we're the brand for gym bros.
Yeah.
You know, like it was not like Nike is kind of, it started as the runners brand. They have never been targeting the like power lifter.
Yeah.
Even though, of course, like, yeah, they're a sports brand. So anyone doing any kind of sports can go for Nike. But it makes sense if you identify one vertical, maybe it's covered by like the umbrella of a bigger brand. But if that's not their core, you can still go after it successfully and essentially just like then you bet on community, right? So like he really went after the gym community, whereas like Nike did that super well with the running community back when they started. But you know, like if that's not their core, then if you have a unique insight and really strong community within that niche, then that's what you can focus on. You can win that and then expand from there.
When you were launching your house of brands, the consumer funding is typically quite tough in Southeast Asia as a region, in Singapore in particular. How did you manage to convince investors to back your house of brands venture?
The truth is I didn't. So essentially, I would say 80 or 90% of my investors are from Europe and the US,
Right.
actually. And also, we didn't want to bring on board VC firms. So we only talk to like very strategic angels. And that is mainly founders and like partners at VC firms, etc. But we actively wanted to make sure that in this round of funding, we only got really strong angels and some family offices. But that meant that we only have, like very few investors from Southeast Asia. But the ones that we did get on board, I think what they really liked was that we had the track record and we had everything in-house. And we had been able to achieve a lot of things in a very short amount of time. And we also had that kind of unique insight. So like that is something that they were impressed by that they didn't see in other companies in this region.
Yeah. And for investors that are still very skeptical about consumer brands or the consumer sector in general, what would you say to change their perspective?
Well, if you don't like consumer investing, like maybe stay out of it. Like it's fine. Not everyone needs to do everything, so that's fine. But also, like as I mentioned, just like why I fell in love with the House of Brands model, for example, is just the sheer potential of what it can become. So again, like just look at the top 50 list of companies by market cap, and more than 15 are House of Brands. It's just like, do you want to ignore that big chunk of like potential massive companies? In my view, it's just like look at the numbers and see what it can get you.
Absolutely. So for all of our listeners, if they wanted to follow your work and kind of, because I know you're quite active on LinkedIn and you share lots of your insights, where is the best place to follow you and get in touch with you?
It is probably LinkedIn. That's probably number one. Of course, check out our website, thewildventures.com as well, but otherwise LinkedIn for sure.
Yeah, I'll have all of the links in the description box for everybody listening. To wrap up the episode, I think let's do a quick fill-in-the-blank blitz. I will read out a sentence and you will complete it with the first thing that pops into your mind. The most overlooked factor in evaluating a great consumer brand is?
Ability to create customer obsession that can turn into IP. So think like, Marvel, Disney, like they're fantastic at creating IP.
Wow, that's such a good answer. The biggest red flag that makes me pass on investing in a brand is?
Lack of grit and scrappiness from the founder. Like if they haven't been able to achieve much with limited resources.
The one thing every consumer brand founder should do before launching is?
Secure something unique. Like you really need to have something unique, and it can be supply chain, distribution, whatever, but just make sure that you have something that is unique for you.
The hardest part of scaling a consumer brand is?
Breaking through the noise. It's just so many brands out there, everyone trying to talk to the same audience. You have to find a way to consistently break through the noise.
The one thing I wish I knew before starting my own brand is?
How much work it is and how much random things you have to deal with. That's definitely it.
Putting out fires every day. You wake up and you're like, what today?
And so many weird random things you just thought would like work, but all of a sudden breaks.
Yeah. The biggest mistake founders make when raising money is?
Not creating FOMO. So being in that limbo of kind of racing.
And last one, if I had to bet on one major trend shaping consumer brands in the next 5 years, it would be?
Wow, that's tough. I think with AI, the funny thing is I don't think we've mentioned AI a single time, which is probably the only conversation I've had in the last few months that haven't. But with AI, you can actually do super personalized journeys. And I think that is the main thing that will change. That you can really build for communities and go super niche. And I think that is something in the next, few years people will come to expect. because before it just wasn't feasible. But now with AI, that's something you can do. So the brands that understand that and capitalize on that will have a massive advantage.
Thank you so much for your time today, Bjorn. I think today's discussion has been one of the most insightful conversations I've had. Thank you so much for sharing all of your knowledge and experience with myself and our listeners and our viewers. It's been great having you. I think that's it. Yeah, thank you.
Awesome. Thanks so much for having me.